Welcome everyone. This is our Roth IRA webinar. I had a client, Joe, who had traditional IRA accounts at 10 different banks. Yes, that's 10 different accounts. He liked taking the RMD out of each account. That was his own way of doing his bookkeeping. However, one year he forgot to take the RMD out of one account. He had to pay $15,000 to the IRS for that one mistake. Now, Joe converted his traditional IRAs to Roth IRA accounts. He would never have to worry about RMDs again. Tonight, we're going to share with you tax planning strategies that could benefit you and your family for decades to come. What you're going to learn is strategies that solve the tax problem with traditional retirement accounts, how to create tax-free income with a Roth IRA and avoid RMDs at 72, an alternative to the Roth IRA, and then a strategy that solves the stock market risk problem so that you make sure that your money lasts as long as you do. My name is Michael Owens. I am the president of Carolina Financial Services Group. I've been an advisor for 30 years now, and my team and I are retirement income specialists. We help pre-retirees and retirees design an income plan so that they can sleep well at night during retirement. We also use risk reduction strategies that either reduce, transfer, or eliminate the major risk for your retirement. Now, lots of times I get asked in these meetings that what motivated me to become an advisor. And it's a personal reason for me. My motivation comes from both of my grandparents who had to have stay-at-home care during the last few years of their lives. They were both raised on a farm. My grandmother's name was Annie. She was a teacher and a principal. My grandfather's name was Mark. He was a farmer. Now, my grandfather was diagnosed with Parkinson's disease at the age of 70. This disease took control of his lifestyle. It forced him to depend on others to help him get out of bed, to go to the table to eat, even put his clothes on and to take a bath. Now, fortunately, they had Social Security income, pension income, and some other sources of income to cover the cost. He died at the age of 79. My grandmother at the age of 93, that's when she needed stay-at-home care. She died on Christmas Eve at the age of 95. Her stay-at-home care cost $36,000 a year. And this was over 35 years ago. Today's cost of stay-at-home care starts at $55,000 a year. Now, how much do you think stay-at-home care will cost in 10 to 15 years? Put that in the chat box, if you will. How much do you think stay-at-home care will cost in 10 to 15 years? How have you prepared for this type of risk for your retirement? And my point is this: you must be prepared for the ifs and not surprised by them during retirement. You must be prepared for the ifs and not surprised by them during retirement. Now, this is a live event. Before I get ahead of myself, if you can hear me and see my screen, please type yes into the chat box for me. If you can hear me and see my screen, please type yes in the chat box for me. Now, to get the most out of this webinar, stay focused, silence your phone, exit out of any other tabs you've got on your computer. If you're in a room, close the door, and again, focus. Please ask me questions in the chat box. Now, the workshop will probably answer most of your questions. And do me a favor, grab a pad and pen to take notes. During tonight's workshop, from time to time, I will suggest to you to write some information down. This is very important for you to do, so you could go back after our meeting or visit and review your notes. Okay, it looks like everyone can hear and see me. Now, we do have a special offer tonight. And that offer is this: if you stay with me all the way until the end, you will be eligible to get the offer. I'm going to show you what that looks like here really quick. You should see the sliding come in on your screen there, and I'll pin it to the top of the chat box as well. Now, this offer may be for you if you are concerned about paying taxes during retirement, if you want to determine if you are a good candidate for a Roth IRA or a TFRA. And what we have found is that many people that attend our workshops are actually searching for a better retirement outcome than what they currently have. This offer could save you thousands of dollars. And I'm going to go back to the offer one more time and pin it to the top of the chat box for you. Okay. Now, once you click on the green button, you'll see this page pop up. It looks exactly like what you see on the screen. Every blue dot is a day, so you click a date that works best for you. The second page will pop up, and this is on the right-hand side. You'll see the time slots. So you pick a time slot that works best for you. And then finally, the third page. On this page, this is where you put your name, your email, your phone number. It is very important for you to share with us why you want to take advantage of the offer. This will help us understand what you want to talk about during our call. And then finally, don't forget to hit the schedule event button. Now, to make this call really worthwhile, you'll need to have your IRA, 401k, TSPs, 403bs, 457s, your retirement account statements in front of you during the call. If you're married, we would recommend that both spouses be on the call. Or if you have another person that helps you with your finances, we would recommend that that person be on the call as well. And you should be able to see the offer there at the top of the chat box. One of the common focus in retirement planning is how are you going to be taxed in retirement? And we're going to share with you tonight how to make your retirement income as tax efficient as possible. When we go in to solve for taxes, the problem with taxes in your retirement is that traditional investments, IRA, 401k holders, when they start taking withdrawals or income out of the retirement account, that's when you get taxed. And that's when the IRS starts getting money from you on your retirement assets. Now, the solution to this is, in order to create the best retirement income possible, we must find a tax-free solution. These are the three buckets. The very first bucket is the tax now. That's your personal money. More than likely, you've already paid taxes on this money. Those are accounts, brokerage accounts, stocks, bonds, mutual funds, CDs, savings accounts. So that's the tax now bucket. The second bucket is the tax deferred. And those are things like retirement accounts, qualified retirement accounts, TSPs if you're a federal employee, 401k, IRAs, 403b, 457s, and annuities. The last bucket is the tax-free bucket, and that's the bucket that you want to pay attention to. That bucket includes municipal bonds, tax-free bonds, Roth IRA, and the TFRA. I'm going to recommend you write this down. And also, too, I would say that you can take screenshots as well, so feel free to do that. But write down TFRA, and what that means is tax-free retirement account. TFR stands for tax-free retirement account. So let's take a look at what taxes have looked like historically. If you look closely, you may not be able to see this, but if you look closely, you can look and see in the 1950s and 60s, the federal income tax rate was 90%. 90%. For every dollar you made, the IRS got 90% of that dollar. Now, how could anyone survive in that situation? What have you done to prepare for higher income taxes during your retirement? Take a look at some other numbers here. The U.S. national debt is over $31 trillion. U.S. total national debt is over $195 trillion. Social Security liability is $22 trillion. Medicare liability is $34 trillion. Higher debt can only be paid by higher taxes. So what is a Roth IRA? It is an individual retirement account. It is designed to help supplement income. It's designated for retirement. You can withdraw money from it starting at age 59 and a half. We're going to take a look at the difference between traditional IRAs versus Roth IRAs, and also the contribution limits as well. If you want to create a tax-free income, a plan for your money to last as long as you do, and avoid the RMD at 72, then you should take advantage of our offer. Using this strategy, people have saved hundreds and thousands of dollars in taxes during their retirement by properly using the Roth IRA and the TFRA. Okay, there's a lot going on with this slide. Again, feel free if you want to take a screenshot. With a traditional IRA, you are taxed on the harvest, which is the larger amount when you retire. I'd write that down. With a traditional IRA, you are taxed on the harvest, which is the largest amount when you retire. With a Roth IRA, you pay taxes on the seed, which is the smaller amount. Write that down. With the Roth, you pay taxes on the seed, which is the smaller amount. So if you go across the board here, the contribution source, again, comparing traditional IRA to Roth IRA, for the traditional, it's pre-tax. For the Roth, it's after-tax. For the contribution limits, that depends on income and tax filing. The same thing with the Roth IRA. Withdrawal rules. If you withdraw money from your retirement account, your traditional IRA or other traditional retirement accounts, you're going to be penalized 10% if you're under the age of 59 and a half. With the Roth IRA, the income contributed can be withdrawn at any time without penalty, but the investment gains incur an extra, again, 10% tax penalty if you take the money out before 59 and a half. Taxes paid, taxes on the income and the capital gains with the traditional IRA, no taxes on qualified distributions for Roth IRA. And last but not least, distribution requirements. There are required minimum distribution requirements that you have to meet starting at age 72 with a traditional IRA. Roth IRA, there are no RMDs. Which would you rather have? Have to take the RMD and pay taxes on it with the traditional retirement account, or go with the Roth IRA and have no RMD? You decide. So let's go back into this a little further. With the traditional IRA, you get the tax break now. So you get that up front and you pay no taxes on the money you put into the traditional IRA until you withdraw it. Now that creates a tax problem when you retire. Some would call it a tax bomb. With a Roth IRA, you get the tax break later. So the money you deposit has already been taxed. You pay no taxes when you make withdrawals after 59 and a half. Now there are some Roth IRA income limits. If you look on this chart, in the middle of the chart, it has 2022 MAGI. So if you're married filing jointly, you make less than $204,000 a year, you can make the full $6,000 contribution or the $7,000 one if you're over age 50. If your income is between 204 to 214, then it begins to phase out. And then once the income goes over 214,000, you're ineligible to make contributions to a Roth IRA. Now, here are some of the roadblocks that you'll see. One is if you're already retired and you don't have any earned income to show. Two, if you're a higher income earner. And the other is the maximum contribution limits are too low. They're too low to help you actually save prior to retirement. So depending on your income, you may be phased out, or if you earn too much, you may not be able to put any money in at all. What is the secret to maximizing a Roth IRA? The secret is a Roth conversion. It is a Roth conversion. You do not need to have earned income to participate in the strategy. There are no income or age limits at all. You're allowed to convert as little or as much as you like. Write that down. With a Roth conversion, you are allowed to convert as little or as much as you like. Take a screenshot as well. So let's go back to the federal income tax brackets and rates. And look at the married filing jointly there. From up to $20,000, that tax bracket tax rate is 10%. If you make above 20 but below 83,000, it jumps up to 12. From 83,000 to 178,000, now you're up in the 22% bracket. From 178 to 340, you're now up to the 24% bracket. There's also a 32% bracket and a 37% bracket. Again, these are the lowest rates that we have seen in modern history. Where do you think tax rates are going to go in the next 10 to 15 years? With the Roth conversion, this is really the question you have to answer. Would you rather pay taxes on the seed, which is the smallest amount, or the crop, which is the largest amount? Pay taxes on the seed or pay taxes on the crop? You see, the goal is to keep the government out of your business and out of your pocket. This is why you'll find it so beneficial to take advantage of our offer. Our analysis will help you determine if in fact you are a good candidate for a Roth conversion. So which will it be? Pay taxes on the seed, the smaller amount, or pay taxes on the harvest, which is the largest amount. Required minimum distribution. They must be taken out starting at age 72. And when this happens, that creates more taxable income, which creates more taxation. Now, regardless of whether you need the money or not, the IRS is going to have its hand out when you turn 72 and will say you must take the RMD out every year thereafter. I will tell you, I'll mention this to you as well. There is a bill floating around Congress that will increase the RMD age to age 75. It's not been passed yet. I don't know if it will be passed, but there is a bill out there that would actually raise the age from 72 to 75. Now, the RMD and again, the IRS, you are forced to take out more and more money over time. And these distributions can bump you up into higher tax brackets. That's why we took a look at those brackets just a few minutes ago. So the RMD could actually push you into a higher tax bracket. It could also cause you to pay more taxes or more money for your Medicare Part B monthly premium. Not having a tax plan for the future can have major effects on all of your retirement assets. As I mentioned earlier, if you miss taking that RMD, you will pay a 50% penalty. You cannot afford to make this mistake. And people make it over and over and over again. Now, I mentioned when we first started, I mentioned Joe, a client of mine, and this is, I'm just giving you some more details about that situation. If you missed a $20,000 RMD, you're going to pay $5,000 income tax, a $10,000 penalty. That's the 50% penalty. So you pay, or Joe paid $15,000 total tax plus penalty, $15,000. So out of the $20,000, $15,000 went to the IRS, $5,000 went to the client. Not so good for the client, pretty good for the IRS. Now, can you imagine going home and telling your spouse, I am so sorry, but I made a huge mistake with our RMDs. We owe the IRS $15,000. Now, my wife would say, what do you mean we owe the IRS? Now, if you think about it, how would you feel if this happened to you? If you would like more details on how to avoid mistakes like this, take advantage of our offer. Okay, the next few slides are very important. So I would encourage you to really pay attention. If you need to get up, stand up and stretch for a minute, go ahead and do so. But I really want you to focus on these next few slides. If you have money in a traditional IRA, you can move that money to the Roth or into the Roth IRA. Once you've done, have moved it from the traditional to the Roth, at that point, you will have to pay some taxes. And there are two ways to pay for the taxes. One is when you file your return, or as the transaction takes place. When we plan for the future, we can pay less in taxes and allow ourselves to create more of a retirement benefit. If executed properly, Roth conversion planning can create huge tax savings. If executed properly, Roth conversion planning can create huge tax savings. Okay, before we move on, and before you jump off and say, well, yeah, I think I can do this on my own, understand this, that there are limitations and there are things that you need to be planning for. If you do this wrong, you could increase your healthcare cost, increase taxation so that it bumps you up to a higher tax bracket, and then increase capital gain taxation as well. Take advantage of our offer and we will help you determine if you are a good candidate for a Roth conversion. All right, we're going to take a look at the TFR. Just to remind you, TFR stands for tax-free retirement account. If you didn't write that down before, write it down now. Tax-free retirement account stands for, TFR stands for tax-free retirement account. When you're looking at municipal bonds, and if you go back and remember that third bucket, the tax-free bucket, that included municipal bonds, the Roth IRA, and the TFRA. So if you look at municipal bonds, you'll see that there is no stock market risk. The interest off of it is tax-free. However, the returns are extremely low. When you compare that to the Roth IRA and many times is invested in the stock market and bonds in some form or fashion, where you have risk of your money, meaning you could lose money. There are some funding limits to the Roth. Now, the interest and the money you take out is tax-free. When you look at the TFRA, there's no stock market risk. There's virtually no limits as to what you can contribute. And the money you take out is tax-free. So what's the catch? Well, the catch is you must qualify for the tax-free retirement account. We've talked a lot about taxes tonight, so I just wanted to briefly mention stock market risk. The problem with traditional investments and IRAs, 401ks, 403bs, 457s, TSPs, the problem with those accounts is that you are exposed to market downturns. And this can be detrimental to your retirement income. It can be incredibly difficult to recover from this during retirement. It can take nearly 7 years to recover from just one major downturn. So what's the solution? We need to eliminate exposure to stock market downturns. During retirement, you do not have the luxury of waiting for the market to come back, because time is no longer your friend, it is your enemy. By the way, today the market sold off again some. Some have said on anticipation of the May inflation number coming out on Friday. We'll have to see what those numbers are and see how the market reacts. Based on me and other experts' opinions, I don't see anything changing or improving the situation on higher inflation, higher taxes, higher interest rates, higher gas, higher food prices. So let's compare the TFRA to some other types of investments or accounts. So if you look under the TFRA column there, you'll see that there is no stock market risk. It locks in the gain every year, and when there's a year that the market is down, it locks out the loss. It does have long-term care benefits tied to it. The earnings are assessable prior to age 59 and a half. Earnings assessed are tax-free. It does offer tax-free lifetime income. Let me say that again. It offers tax-free lifetime income. If you look at the other accounts to the right of that, there are not many checks there. The closest thing to match the TFRA is the Roth IRA. You see the problems with status quo. There are two primary risks that could ruin your retirement. One of them is taxes. The other is stock market risk, having too much money in the stock market while you're retired. Either one of those could cause you to not have enough income during your retirement. This is an old Chinese proverb that I like a lot. And it says this, it says, the best time to plant a tree was 20 years ago. The second best time is now. So if you're considering making a change in regards to your retirement, and if that change will help you get a better retirement outcome, the best time to do that is now. The best time to do that is now. Okay, I want to congratulate you. You made it all the way through with me. We're near the end of the webinar, so our offer is this. It is a Roth conversion analysis. In this analysis, just to name a few things, we will help you determine if you are a good candidate for a Roth conversion. We will help you determine if you can qualify for a TFRA. We will also look at how your current retirement plan addresses stock market risk, inflation risk, long-term care risk. So how much does this cost? Many advisors normally would charge $1,200 for one consultation. I will tell you this, it is worth every penny of that, every penny. This is the best money you will ever spend. It will help you put thousands of dollars back into your retirement lifestyle. Now, I'm happy to share with you that we are offering a complimentary analysis, and that is our way of thanking you for watching this webinar. Now, to make the most out of the call, please have your IRA statements, 401k statements, other retirement statements out during our call. So and I'll put the slide back up, and also on the chat box, it's at the top of the chat box too. You just click on schedule call. So when you click on that link, you'll see my calendar. Again, it looks just like this. The blue dot, there's a blue dot for each day. Click on the date that works best for you. And this will take you to the second page. On this page, look to the right, you'll see the time slots on the right. Click on a time that works best for you. The third and final page, you enter your information, your name, your email, your phone number. The next section is really important. Please share with us why you want to take advantage of the offer. This will help us to determine what you want to talk about during the call. And don't forget to click the blue schedule event button. To make this call really worthwhile, please have your IRA, 401k, other retirement statements out in front of you during the call. Now, if you're married, we would recommend that both spouses be on the call, or if another person helps you with your finances, we recommend that that person be on the call as well. I'm going to wrap things up here by asking you this. What stood out to you tonight? If you would, type that in the chat. What stood out to you tonight? My second question is there one thing from this webinar that you would like to apply to your retirement situation? Is there one thing from the webinar tonight that you would like to apply to your retirement situation? You should see the pop-up again now so that you can go ahead and schedule a call with us. I will share this with you. When we have these webinars, our calendars get full really quickly. So if you feel like that you want to have a call with us, I would recommend and suggest that you go ahead and schedule one tonight. Knowledge is power, or there's a saying that knowledge is power. I don't believe that. I don't think that knowledge is power. What I believe is applied knowledge is power. It's going to be uncomfortable for you to get out of the status quo, but if it will give you a better retirement outcome, you have to get over that uncertainty and get over being uncomfortable just because you're getting out of the status quo. I hope we've answered most of your questions tonight. I'm going to check the chat box to see if there are any questions for me. Thank you for spending a few minutes with us. Have a good night and take care. All right, let's see if we got any questions here. Okay. Yeah, I see, let's see. All right, I see a couple of people that say that they can't get into the calendar. So I will email the link to that calendar to those people. Okay, there are a couple in here. I apologize for that. I've got two people that say they cannot get into the calendar, so I will make sure that we've got an email sent to you with that link. Okay. I don't see any questions. Again, thank you for watching the webinar with me. Have a good night and take care.